Welcome to today's session. My name is Beatrice Njoroge, and for this session, we'll be talking about financial accounting introduction part of it. So let's go. What do we mean by financial accounting? When you talk about financial accounting or accounting in general, it's an act that consists of four key terms or steps. That's why we say it's an art of recording, classifying, summarizing in a significant manner, and in terms of money, transactions and events which are, in part, at least of a financial character, and interpreting the results thereof of interested users. So these are the four key steps or parts of accounting, and we are talking of in terms of money because when we are accounting, we don't count the assets themselves, like how many assets do we have, but we value or we count the assets or the items we want to account for in terms of money. So what do we mean by recording? The accounting term for recording is generalizing, or which comes from the word journals. All the accounting events are recorded in a journal. So as we shall see later, in accounting, we prepare journals, and these journals are the ones that are forming part of the recording. Then the second part of the definition is classifying. So when we do the recording, we go to the classifying, and the accounting part of this is posting to the ledger. All accounting events that are recorded in the journal are then classified or posted to a ledger, as we shall see later on how we post these events in a ledger that are recorded already in a ledger. Then you have the third part, which is summarizing, and the items that are classified or generalized are posted or are posted in journals are summarized in terms of financial statements, and we have various financial statements. One of them is income statement, or what is called trading profit or loss account, or the profit or loss account, or statement of comprehensive income. And we also have the balance sheet, which is also known as a statement of financial position. And the last part, which is the final step of the accounting process, is the interpreting. So after transactions are recorded, classified, and summarized, these results need to be interpreted, to be given meaning so that they can be understood and used by people who need them. And these people who need them are called interested users. So that is the basic definition of accounting or financial accounting, which comprises of the four steps or processes, which is recording, classifying, summarizing, and interpreting. Having looked at the steps or the definition of financial accounting, it's now very important to look at the objectives or the aims or the goals, or why do we do financial accounting, or why is financial accounting important. So you have various objectives of financial accounting, and the first one is systematic recording of transactions. Every business will have many transactions or more than one transaction, and there's a need for recording these transactions in a systematic manner. That's why we are saying financial accounting ensures that all business transactions are recorded accurately and in an organized manner following a standard procedure. And why do we do this? This helps maintain complete and reliable financial records. The second objective is ascertainment of results of above recorded transactions. So we've done the systematic recording, so it should be ascertained, or the results of the recorded transactions should be ascertained, and this involves determining the profit or loss of the business of a specific period by preparing the income statement, profit and loss account, and shows how well the business has performed. In other words, how will we know if a business is making profit or loss? The financial statement we'll be preparing in this case will be the profit and loss account. Whereby we'll get the net profit or the net loss, and that will show us is a business making profit or loss. The third objective is ascertainment of the financial position of the business. How do we know the financial position of the business? This is done by financial statement that we prepare later on called the balance sheet or the statement of financial position. So by preparing a balance sheet, financial accounting shows the financial position of a business at a specific date. And statement of financial position comprises of three things, that is the assets, liabilities, and capital. What is an asset? An asset is what a company owns. What is a liability? A liability is what a company owns others. And we have capital, which is also called equity. The fourth objective of financial accounting is providing information to the users for rational decision making. So from the definition, we looked at the interpreting part whereby we said this information is important because it is relevant or it will be useful to the users of that financial information. So financial accounting provides useful financial reports to both internal and external users. Who are the internal users? Internal users are basically the managers, and the employees also have investors and creditors to help them make informed and logical decisions. And the fifth objective of financial accounting is to know the solvency position. It helps assess the business ability to meet its long-term debts and obligations. This is important for creditors and investors to judge the financial strength and stability of the business. Every creditor, every investor would like to know, should they invest in a company? Should they give goods to a company on credit? So basically, these are some of the objectives of financial accounting. Now, I want us to look at users of financial information and their needs. From the definition and from the interpreting part, we talked about users. So the question is, who are these users of accounting or financial information, and why are they interested in this accounting information? One of the users is the shareholders. Shareholders are the owners of the business or the company. And why do they need accounting information? They would like to assess the company's performance and profitability, helping them make informed decisions about their investment, about the shares they invested or the shares they bought in that company, or their shareholding position in that company. Then we have the government. Why should the government be interested in a company's financial position? Basically, it's because the main reason is because of the assessment of taxes. So one of the reasons is the reason of the assessment of taxes. So the government uses accounting information to assess taxes, issue permits, regulate business, and address economic issues such as inflation. You also have employees. An employee would be interested in the accounting information of the company they are working for. Why? To understand the company's performance and assess whether it can provide salaries, benefits, and job security. An employee would like to know if a company has made more profit, should they maybe require, or should they have some salary increment or some benefits or some bonuses, or their working conditions improved, or even their job security improved or being enhanced. Then we have suppliers and trade creditors. Before a supplier or a creditor gives goods on credit, would like to know, is this company able or in a position to pay them back their money? And that's why it's good to have this accounting information to evaluate a business creditworthiness before selling goods or services on account or on credit. Then we have customers or clients or consumers. So a customer is a person who is basically buying goods or services in a company. And why are they interested in accounting information? To assess a business financial stability, especially for long-term engagements, and to judge the fairness of pricing. A customer would like to know if this company maybe is making profit, should they continue having long-term engagement with them? If the company is making loss, if the company's possibility is closing down, for example, should this customer look for an alternative company to be and to have long-term engagements or to buy goods and services from them? Then we have lenders. Lenders can be people who are giving loans, such as financial institutions or banks. They would like to know, is this company in a position to pay back the loan or the amount of money they have given the company? So lenders such as banks use accounting information to determine a borrower's ability to repay loans and interest on time. Is this company in a position to pay the principal and interest on time? Then we have investors and businessmen, and they used accounting data to evaluate profitability, financial health, and to make decisions about investing, expanding, or discontinuing operations. So, should an investor or a business may continue investing in a company or discontinue operations with that company? And also we have the public, which uses accounting information to stay informed about businesses, manage personal finances, and make economic decisions. So basically, those are the users of accounting information and their needs.